Welcome everyone to our panel. I would like to introduce the panelists, and now I have to go Alice first. So, first of all, on this side we have Alice Usanase. She's the lead for Europe, Middle East and Francophone Africa at the Africa Finance Corporation. It is a multilateral development financial institution which was established in 2007 by African states to provide pragmatic solutions to Africa's infrastructure deficit and challenging operating environment. The corporation bridges the infrastructure investment gap through the provision of debt and equity, project development, technical and financial advisory services. So, Alice on the right-hand side, first panelist. Second then is Victoria. Victoria Miles is the CEO and CIO of Impact A Global. She's an expert in the delivery of innovative structured solutions for clients in emerging markets. She brings deep knowledge of project and infrastructure finance together with emerging market investment and risk management at the Impact A Global management level. She has more than 30 years of experience in structured and bespoke investment in Latin America, the Caribbean, Eastern Europe, Central Asia, Africa, Southeast Asia, with a focus on infrastructure finance in frontier and emerging markets. Then, in the middle, we have Geoffrey White. He's the CEO of Agility Africa. He has more than 30 years of experience in infrastructure development, retail supply chains, agribusiness, and investment in African markets. Agility Africa is a company that is listed on the Kuwait Stock Exchange and is the leading developer of warehouse parks in the MEA region. With a site portfolio of more than 12 million square meters, Agility Africa is funding, developing and managing a network of warehouse parks across Africa that they provide an international standard infrastructure to support multinational corporations as well as local ones, so supporting SME growth in Africa. Last but not least, we have Michael Aldridge. Michael is the founder of Kofisi, that has the goal to revolutionize the workplace sector in the African continent by delivering quality interior design and hospitality-led shared office space for enterprises. He has pioneered the idea of hotelification of the workspace, which sounds very nice. I feel already very comfortable there. On the continent, successfully disrupting the commercial workspace model in Africa, which allows businesses to access the opportunity from fully supportive and elevated flexible work environments. There was already a little bit introduction about myself. My name is Christoph Both. I'm very glad to be your moderator for today. And the topic we have in very brief terms up there is about infrastructure in Africa. I think we can all agree that infrastructure development is a key driver for progress across the continent and a critical enabler for productivity and sustainable economic growth. It contributes significantly to human development, poverty reduction, and the attainment of the Sustainable Development Goals from the Paris Accord 2015. Investment in infrastructure accounts for over half of the recent 5 to 10 years, improvement in economic growth in Africa, and it has the potential to achieve even more. On the other hand, we have to face the reality. Africa's vast infrastructure deficit is a constraint on its growth, but it's also an opportunity to leapfrog to a new, more efficient technology level. As Africa becomes more urbanized, public goods and services will be easier and cheaper to deliver to a more geographically concentrated population. Key challenges will be the supply of the burgeoning population with reliable electricity, affordable housing, and transport infrastructure regarding transport logistics. These industries also have the potential to create new jobs. In the recent past, the African governments have shouldered the bulk of the investment needed and relied heavily on external borrowing, which in the recent past has put constraints on them and limits their fiscal maneuverability. We've seen in many countries in Africa the debt levels increasing considerably in the past. And there's more than ever the need to create favorable conditions for the private sector to play a greater role in this infrastructure financing, with government players not having the financial viability to this anymore. So these questions, these topics, I would like to elaborate a little more here in the round of our panelists. And the first question I would like to ask to one of the clients. Very often I ask for 2 responses. If there's questions or remarks in the audience, please feel free to raise your hand. I can hardly see your faces because of the lights, but somebody here from the organization team can help us. So the first question would be to Geoffrey. With your track record to date for investing in 5 countries in Africa and I think in the Middle East region, what have been your main challenges and the constraints that you have experienced as a developer?
So thanks, and it's a pleasure to be on the panel. I think from our perspective, if you look at what we do, we're actually trying to make the ease of doing business and investing and in companies coming into Africa simpler, faster, and more efficient. So the big constraints that we eliminate by our business strategy is we build warehouse parks. Within those warehouse parks, we typically buy somewhere between 300,000 and 500,000 square meter plots of land on the edge of the major cities in Africa. We then build at risk the first phase, and the point of that being it eliminates 2 of the biggest constraints to investing in Africa. So one is that everything takes much longer than you actually expect. So with agility, you can come see one of our international standard warehouses. It's there, you can visit it on a Friday, and you can move in the next week once you've signed the lease. So we eliminate that long traction that puts a lot of foreign direct investors off going into Africa. The second aspect is we de-risk the title. So we've already bought the 300,000 to 500,000 square meters. And to put that into perspective, that's quite a big piece of land. It's the equivalent of about 80 football pitches. So we buy a big piece of land, we build the warehousing, we eliminate the title risk, and everybody in the room who's dealt in Africa knows people who have bought a piece of land and then there's been all sorts of title issues after you've had it. We've gone through that process and have a secure and clean title wherever our projects are. In Nigeria, for example, it took us 3 years. We bought land from the government thinking that was probably the safest way to buy it. We moved in 3 years ago to start development. A whole bunch of people came along and said, no, this is our land, not your land, even though you've got a new CFO title deed from the government. We had an indemnity with the government when we bought it, but it's actually taken 3 years for the government to clear all those cases out, go to court, settle everything with all the claimants. And we literally just last month got our new title deed. But meanwhile, we've absorbed the 3-year hassle of getting clean title in Africa, in Nigeria, that you can actually build on. So I think the things that we mitigate as a strategy is title risk, construction risk. Because we build a templated warehouse product that we develop, we take away all the construction risk. We know exactly how much it costs us to build, and we can deliver that. We deliver it hopefully on time because we're doing it on multiple locations and we understand the process. So there are significant risks to going in and setting up a business in Africa from a production perspective. If you look at our customer mix, about 60% are multinationals, 40% are local SMEs, all of whom are looking to come into a compliant, efficient, secure environment where they can run their businesses. But the use of the warehouses we lease to people is interesting as well, because 50% is traditional storage, racking, distribution center, but actually 50% is some sort of added value where you're bringing in bulk materials and then you're processing them, light manufacturing, agri-processing for export, etc. So we've got a very wide band of customers, but what I think is significant is our strategy is very focused on making the ease of whether it be foreign companies coming into Africa or SMEs growing and expanding, just making that journey much, much easier. So as I say, we take the risk, we buy the land, we secure the land, we're very comfortable the title's ours by the time we start developing. We try and match our development with demand so that we've always got warehousing available for customers so they can either expand if they're an existing customer, or if they're a new customer, they're able to move in straight away. And we mean you can come into doing business in Africa on a much less capital intensive model. So if I give you an example of one of our customers in Ghana, when we first met them, they're a big multinational company. When we first met them, they had an $8 million project to go into Ghana, buy a piece of land, buy a production facility, and their business plan was $8 million investment, and in 3 years we'll be selling in the Ghanaian market. They were able to come into one of our warehouses, which was 95% sort of suitable to what they were actually going to build themselves, and they were able to move in straight away. So rather than $8 million, they ended up investing $1.5 million. And rather than taking 3 years to get into the Ghanaian market, they were actually selling goods in 6 months. So it has a real impact on the speed of people actually executing businesses across the continent. So finally, we're in Egypt currently, we're in Cote d'Ivoire, we're in Ghana. We just started construction after a 3-year wait in Nigeria. We're open in Mozambique. All of those projects are full, and we're expanding them, and we're looking to go into more countries across the continent to, again, de-risk our customers. So we've got, when we talk to customers, they want to be in multiple countries, but they don't want 30 different landlords all across the continent. They want the same quality, edge advanced certified buildings that they can just replicate as they go into different countries. And we see that very much aligned with a couple of macro trends in Africa. One, the opportunities of the Continental Free Trade Agreement are going to develop across the continent. Secondly, a distinct move to producing things locally, where manufacturers who used to produce vast quantities in China or in Asia have actually, because of the logistics coming out of the COVID, current problems with the Suez Canal, with the Panama Canal, and the unreliability of global logistics, are all saying, actually, we want to produce closer to or in market. So we're seeing manufacturers who are saying, actually, we want to produce in Ghana, we want to produce in Nigeria, etc. So we're seeing this move of local production going into Africa. I think more and more international companies understanding the demographics and the market opportunity in Africa, in contrast to their traditional markets, which are all declining and maturing. So I think there's a huge momentum for Africa. Certainly we're seeing it, and it's a question of getting the infrastructure on the ground. So the last point I would probably mention is, if I'm building a warehouse in Africa, it takes me to build, it takes me 25% longer than building it elsewhere in the world, and it costs me 25% more than building it elsewhere in the world. And that's a direct reflection of the cost of logistics in Africa and the poor infrastructure to actually get the materials on site and get them constructed. So infrastructure is the solution, really, to African growth.
Thank you very much for that, Geoffrey. And I would like to highlight 2 items here. De-risking is one important issue, but also localization. So no longer import, but import substitution, manufacturing on location for the local market. That is very important. And that takes me to the second step. When we talk about infrastructure, very often, as a banker myself, I always looked at the large-scale projects, hundreds of megawatts, billions of dollars to be invested, but that's only the primary infrastructure. Everything that creates many jobs and has direct and indirect impact on the local community is coming from the secondary infrastructure. And I would like to talk to Michael about this. I would like to ask him a question. And in this case, how do various service models align with and support the infrastructure development programs in Africa? And if you want to elaborate more on the secondary infrastructure, not the big scale, but the smaller scale, I would be happy to.
That's great. I mean, we're very excited about infrastructure, right, in all constructs, you know.
We all are.
And, you know, with Kafisi, which most enterprises know what we do in terms of our construct, but with Kafisi, we're very much focused on the secondary infrastructure, as in the commercial space, but what we talk about thematically could also apply to residential. I mean, there's a lot of obligation that can actually come with the journeys of development inside each country and specifically around secondary infrastructure, where because of the nature of its cross-border application, it comes with it a big responsibility, an onus for us to design well, right? So when we put these buildings up and we provide the space that's required for companies, we need to actually really think about the way that that's constructed, not just in terms of the physical construction, but what kind of construct it's going to work. Now, everyone in the room here will be very familiar with the leapfrogging concepts for Africa, where we're jumping over legacy systems. And that's very much the case that needs to be thought through when you're considering infrastructure build in secondary. You know, whether it's in service design or in real estate design, what we've got to do is set the bar higher from the beginning. And I think the second point around the leapfrogging is there's quite often a misconception. In fact, I've said it hundreds of times since I've been here, and this is 10 years since I was at the conference before we set up CAFISI. But actually, it's the opportunity on the ground versus the story that's written and that you're reading about. Like, the distance between those two is where the entrepreneurial opportunity sits. And actually, the misconception is what's actually required and what people want. It's, you know, it's faster internet in Kenya than it is in London. You know, it's better fintech, right, than it is in many places in the world. I mean, and there's a demand for new. And so with all of these themes, when we consider secondary infrastructure, we've got to make sure that we're future-proofing what we're putting down on the ground. And that was really when, you know, when we established CAFISI with a view to revolutionizing the way workspace could work inside these evolving markets, creating reliable in an unreliable environment. It was by fusing together the concepts of service inside the physical space. And what that means is that you create a much more supportive environment. It's rather like Jeffrey was saying in terms of that turnkey capacity for businesses to be able to come in and to be able to get on with their front of house. Infrastructure plays, as we were saying, plays a major role in the creation of jobs. And that's, you know, what we believe we're doing in terms of our social mission with what we're doing with CAFISI. Not only are we working with local fit-out, local artisans to be able to build and interior design and create the spaces, we're training people to be able to serve inside those spaces in constructs that are working globally. Because if you actually look at secondary infrastructure in the global north, the buildings that are the best designed and the most serviced are the ones that are full. And it should be the same thing when you're considering the African journey and adventure. And it's proven out. You know, we're in 7 markets, we're opening in another 3. We're 100% full everywhere we are. And that's with, you know, the all-important profit metric attached to it. Sort of unlike some of the previous constructs in the shared workspace industry, Africa is very buoyant, and it has 20x growth before to even just to catch up with what's happening in these sort of markets that we're in today. So I think, look, secondary infrastructure often gets forgotten about. We'll talk about it more as we go through the panel, I'm sure. But I think it's a very, very important area for people to think about.
Thank you for that. And I took note that from your perspective or experience, providing the full service package, not just one part of it and buying the other stuff, makes all the difference for you.
I think so. I mean, I think the idea of, if you're going into the real estate, the idea of like transactional relationships between tenants and building owners has kind of died a little bit. Mm-hmm. I mean, I think there's a huge amount of change that's occurred post-COVID, and it's fast tracking its way into the African environment. So it's very important that buildings are thought about with the construct of service as much as they are with just the hard asset going up. Yeah,
okay. That is very interesting. I'm curious also if you can translate this into other sectors maybe, that could be a model that could be used there as well, improving the situation. Now I'd like to, we've heard about the developer side, so operating, developing, constructing and managing such infrastructure assets, but somebody still has to pay for this. And if you don't have, like Geoffrey, a company that does the de-risking in a pre-financing way, then you need someone else. And there we have the financiers invited. And I would like to ask, first of all, Victoria, as a financier, what challenges are you faced with when looking into or assessing infrastructure projects in Africa?
Well, thank you very much, and thank you for the invitation to participate in the panel and for everyone who's joined. I mean, The challenges are there for all of us. I mean, we are involved as a firm in providing debt financing for sustainable infrastructure projects in the sectors that I guess you've mentioned and defined as more primary. So that is energy, clean energy, renewable energy, and renewable materials, biofuels. We are focused on healthcare and hospitals. We're focused on water and sanitation, and we are focused on mobility, and we've touched already on some of the challenges in mobility, whether it's the electrification of urban transport or the simple building out of roads or even tarmacking of the roads that exist. And you know, the numbers I think we're all familiar with in terms of just the shortfall in access to basic services across the continent, over half of the continent without access or consistent access to electricity or mainline electricity, reliable electricity, maybe reliance on diesel generators that are dirty, and the price input of maintaining those can be highly volatile. Over 400 million people across the continent without access to clean drinking water. We feel water often gets overlooked, and with more of the focus on energy, but that really should be a primary right to everyone on this planet. Only 43% of the continent has access to an all-season road. That's hugely challenging for people getting to work, for children getting to school, for access to reliable healthcare and hospitals, but also just slowing the whole continent down in terms of logistics and pushing up the implementation costs. So whichever sector you look at, road mortality on the roads, fatal accidents, I think it was almost 250,000 people lost their lives in Africa because the road transportation is so unreliable. So the needs are everywhere. I think there are many challenges in financing. It's, for us as an impact fund, focused on driving climate transition, but also delivering or reducing inequalities. It's how do you pick which project is the most worthwhile? We look across the continent, and we are cross-border investors. We're taking on long-dated risk in infrastructure. You're usually financing for at least 10 years, sometimes out to 15. And there's only 2 out of the 33 rated countries in sub-Saharan Africa that are currently investment grade. So just getting across that country risk hurdle is a real challenge, and layer on top of that the perceived risk that our investors have of investing in Africa. They said, why would you be investing in Africa when you could be getting the same return potentially in more developed markets in Latin America or even in North America under the current IRS? So addressing that very real challenge of drawing in financing for long tenors. And you look at when a developer or an equity sponsor starts to evaluate an infrastructure project, they're usually committing to a couple of years of work and expense, getting the permits, getting the licenses, buying the land, employing their lawyers, assessing the bankability of the contracts. And they don't have visibility on where the financing rate will be in 2 years' time when it's time to go to market and raise that debt. So I think we could talk about challenges all day long. I'd like to focus on solutions too. There's a lot of work being done by some of the large multilaterals like the World Bank in helping drive more efficient financing structures, PPP structures. That's a big challenge in the infra world, but I firmly believe you've got a new guarantee framework being put together at the World Bank. If you can align those PPP frameworks with the guarantee frameworks that could be offered, you can help incentivize and reward governments for putting more efficient frameworks in place that can give more predictability maybe around the access to finance. We firmly believe It's bringing in more private capital because public resources aren't enough. There's at least a $100 billion shortfall per annum in infrastructure investment in Africa. Some of that may be addressed by the public sector, but probably at least 2/3 has to draw in private capital, but in a smart way, with the public sector taking some of that tail risk to support private sector confidence in long-term investing. And we're also setting up vehicles such as ourselves that provide de-risking to investors at the vehicle level. So we have a number of first loss tranches that have been provided from the multilaterals to us as an investor that help cushion downside risks. So enormous challenges. I think the public and the private sector have a challenge ahead in really aligning and getting behind some standardized structures that we can roll out in a rapid way rather than trying to reinvent the wheel again and get infrastructure delivered in an efficient way, in an affordable way, but on a reasonable timeline as well, because this gap, the timeline gap that we see in Africa in getting projects done is holding everyone, back.
I think there's a couple of great themes there. I mean, like patience is a big factor if we want to be an entrepreneur in the African environment. I mean, it takes 10 years to have overnight success. And I think that, I think also a great theme that you've picked up on there is actually getting attention of the dollars coming into market. Because I think quite a lot of the time we feel as though there's a focus on, not so much not a focus, but like there are areas that aren't being looked at. I mean, I can't deny all the stats you've given, they're absolutely correct, but it's sometimes in our mind, it's like, well, look, the biggest impact you can have is putting food on the table. That's by having a job. Having a job means you need companies to employ, employers need space to work. So, you know, it's almost like the countries are writing the music, they've got the orchestra ready, but they haven't got the instruments to play. Right? And I think that's a really important theme that needs to be understood. And you know, if we had $1 for every time we were told there was a better way to do it in a global north environment, rather than we wouldn't have to raise capital. But you know, it's frustrating. I think that part of the journey in terms of the natural importance of some of these areas around secondary and primary infrastructure that need to be thought through, and also the range, you know, the depth, because those that are investing into secondary infrastructure tend to be localized groups, families, and they're not investing for they are sort of investing for the future because they want the annuity and, you know, it's for the grandkids and everything like that, but they're not thinking about buildings of the future. The demand is today for the buildings of the future. And so there's a cry out there to people who are trying to invest into these markets to actually like go a little bit wider in your thinking. I'm excited to be on this panel because this definition of infrastructure is much wider than you think. It's not these big super projects well, it is these big super projects, but those are difficult in themselves. There's plenty to do in the secondary environment as well.
I actually don't want to stop you, but of course I have an agenda, so I have to follow that. But thank you very much for the input. I really like the idea that we have such a variety of panelists here that work from different perspectives in different sectors, but all of us, we work on infrastructure in Africa. So the challenges we are facing are sometimes the same, and we just heard that the public sector plays a role, and I mentioned it in my introduction. There's a certain limitation of involvement financially from the government side, from the sovereign side. But it's very interesting to see here, like, I would like to use the example Victoria gave for logistics. The implementation costs are quite high because we're starting from scratch most of the times in African countries. In Europe, you would just expand an existing system, which is not that costly, and an infrastructure exists, while you do that from the scratch in Africa. And also, as an impact investor, you have to follow your impact criteria. So it's not like the sovereign, the state would do it for the good cause, the development of society. The impact investor also has to follow some criteria. And we've heard a bit about mitigation that could come from the World Bank by having structures in place where, for example, you not only have an EPC, but an EPC plus finance, where you do kind of a pre-financing, or you use a bridge loan for this particular risky period of construction, while the operations are less risky and you refinance at that stage. So there's new ideas coming in, regrettably not fast enough, so we should accelerate that. But having a look again at the public side, I would like to ask Alice, what do you think the public sector and private sector roles should be or could be in an ideal world?
I think, first of all, it's start to say that challenges are there, but they're also good news. Because I think when we hear the numbers, we typically hear, and we keep hearing the same challenges. That's why the room is half empty, because people think that you're just repeating the same thing and nothing is improving. But and the reality of having such numbers is, and actually, is because things are moving in the right direction. We're only talking about secondary infrastructure because we have made some progress on the primary infrastructure. If we have not made improvement in terms of accessibility to electricity, yes, there's still 600 million people in Africa don't have access to reliable power, but it means there's 400 million more that actually still have access to electricity. When we talk about logistics, we're able to talk about logistics and warehouses because now we have roads that have been built that provide access to ports, and now you need ports to be able to export. So I think what we have to be mindful so we don't have this fatigue because it's such an important sector is things have been moving towards the right direction. It has not been moving at the speed that we hope it to move, but things are moving. And when it comes to infrastructure, yes, I mean, we know it from experience across the globe. PPP frameworks have proven their ways to be able to deliver sustainable and large infrastructure projects. I think what makes it more exciting today is there's a general acceptance among the different stakeholders during the value chain in terms of responsibility, in terms of risk sharing. Traditionally, even till today, 6 to 7% of infrastructure investment in Africa and still even in developed countries they're led by the government. Why? Because they tend to be public goods, particularly in the energy sector, water and sanitation, and transport logistics as well. But you can see that there's much more increased involvement from the private sector, particularly in subsectors. For example, if you look at power sector, 10 years ago, it was mostly between the government, the developer, and financier because it was mostly fossil fuels-based type of energy, and the buyer will be the national electrification company. So the complexity at that stage was really around PPA agreement because there's already a track record in terms of regulatory environment when it comes to fossil-based projects. When it comes to renewables, there is no framework at all, and also there's multiple stakeholders involved. And your job as a financier is to who's going to take the lead in making sure that if the early stage base, what are the stakeholders that are required to make that project sustainable? From a public perspective, you need a cohesive regulatory environment that is going to be consistent if it's tariff with a predictable tariff, and that the PP is going to test the time, change of government, political instability. But it's not really so much the role of the government to provide early stage financing. That should not be their role. That's where you have impact investors, development financial institution to bring in the concession type of funding that is going to make the project sustainable. Victoria was talking about first loss guarantees, for example. Now we have more insurance that can also intervene at that level. That's a role that the impact investors, the type of the World Bank can come and play. Now, when the project has progressed enough, the feasibility studies have been done, the early stage works have been done, then you can talk about long-term financing and who's the relevant person that can provide that type of financing. When it comes to the renewable, there is a higher upfront cost compared to the traditional conventional source of energy. So you need a partner that is going to provide long-term financing. Commercial banks, PE funds are not going to be the right partners for you to do so because they need to exit in 5 years. Their return expectations are too high for that particular sector. So you need DFIs to come in and provide long tenor, or at least to make sure they provide refinancing mechanism for the commercial banks if they're able to provide a 5-year tenor facility, then I can provide an extension guarantee for them to be able to provide 7 to 10 years, and I'll take that risk because I'm structured as an institution to be able to do so. So I think overall, the challenges remain the same, not because there's not improvement that are being done, but more because the scope of work, as Michael was mentioning, has expanded. We're not talking about roads, we're talking about industrial parks, we're not talking about mining, we're talking about warehouses. And that involves different stakeholders, and the role of the public part is to de-risk, provide a cohesive environment, provide early stage mitigation risk that the private sector is not going to be able to do so, and providing also, even at the middle of the project when it's being operational, it's being maintained, the type of instruments that are required to sustain the financing of the project. So I think really overall is a stakeholder management and agreeing from the start of the project how the risk is going to be divided among the different parties.
Great.
Thank you very much. I saw Victoria nodding your head quite often. Would you like to add to that, or is everything already said?
Well, I mean, I love the idea of the extension, the liquidity extension guarantee, because that's one challenge that we really see as a bottleneck for some projects getting developed. And you mentioned, you know, the support of the public sector in de-risking and really letting the private sector play a role. There is appetite out there, and I've long said this. I think it's something like $140, $150 trillion in marketable assets globally. There's plenty of space for, you know, $1 trillion of sustainable finance to be deployed in Africa by the large insurance companies and asset managers, if we can get the right format. But it's got to be digestible. It's got to be it can't be a project that takes 3 to 6 months to understand. It's got to be in some kind of standardized format, and the support of the public sector has to be provided in a way that is relatively transparent and easy to understand, and also standardized. So I know that means you may leave a little bit of value on the table, and that may be more moral hazard in a project that way than might like to be the case. But I think we've got to move forward and take that risk together, that while we wait for perfect, we're just missing too many opportunities. So yeah, but it's all about reducing the friction, I think, in that dialogue, and having a more standardized product. Maybe whether it's BII giving the guarantee or AFC or the World Bank, the guarantee is given in the same format. You're just taking a different counterparty risk. I just think it's all about mobilizing that appetite from the private sector that will be there if the format is correct, and if that deal friction can be eliminated so we can deploy faster.
Okay, thank you for that remark. Well, as a representative of Get Invest, who is a facilitator between different players in the markets, financiers, developers, all the other stakeholders, I feel like between a rock and a hard place right now, because you're all right, and all of these challenges are correct, and we have to address them. Just a very short summary, we talked about de-risking in different ways. We talked about the localization and the regional impact, the urbanization, and technology improves and changes very quickly. And Alice just mentioned the complexity of the whole structure of such project increases. In the past, it was 1, 2, 3 stakeholders, and that was it. Today, as she said, we're talking about stakeholder management in each of the phases of the project cycle, which is different in the beginning, in the early stage, than later in the operational stage. And as Get Invest, we have identified exactly this challenge, the situation, and our role is to be a facilitator between all of these. So we help developers to identify these problems, to address them together with us, find the right people also in the government entities for regulation and permits and licenses. But also on the other hand, We make sure that investors understand the business concept and the business plans faster and easier because they are presented in a format that is easier to assess and to understand and to make a decision on due diligence. So we try to cover this from a different perspective. And I think it was once said that there's a full package to be delivered from the financier, from the developer, and we see ourselves as the one-stop shop as Get Invest, where we also provide all of these services because the complexity does not allow to only focus on one topic, but we have to deal with all of them at the same time, simultaneously, in order to make these projects primary or secondary, large scale or localized, smaller scale projects, infrastructure projects happen. Now we are on the last 3 minutes of this, so I'm not sure if we have a Q&A session. If not, then all the 4 panelists have roughly 40 seconds to send their message if they want. Who would like to start?
Michael started.
You want me to start?
Then we go from this side.
So this is you want a 40-second conclusion?
No, it's only 30.
No, it's only 30. I think it's been a really interesting debate about the way that the dots need to connect to actually make all of these things come together. I just think that, you know, when we started out Kafisi, we were looking to leverage the twin pillars of primary infrastructure investment and technology adoption. And I think that's proven out with the second bounce of the ball being the enterprise maneuvering that's occurred subsequent. But the thing with the tech investing is, you know, tech investing in the global north is about creating marginal efficiencies on pre-existing infrastructure. What you mustn't forget is that the infrastructure isn't always there for the technology to be able to make the best use of. And so I think, again, it's a request to think about this term infrastructure as being much bigger, far more obligated to the growth capacity of the markets. But I enjoyed the debate, and thank you very much for letting me be part of that.
Right. I think my takeaway would be that every day I appreciate that there is pent-up demand that wants to do business in Africa and isn't able to execute it, isn't able to start their business. From an SME perspective, we have a huge number of SME customers, all who want to trade with their neighboring countries. So they don't want to just be a Ghanaian country. They want to move from a 40 million person market in Ghana to be able to trade across the whole of West Africa. But the infrastructure, the constraints on borders inhibits and prohibits them from being able to do that. So there's a pent-up demand. They want to grow and expand. They want to develop their business regionally, but they can't because of the lack of infrastructure. And whether it be systems and processes or actual physical infrastructure, both are constraints to that pent-up growing demand. And the same with multinationals. We have a huge number of multinationals that come and see us, say we want to come and open up a production plant in Africa, or we want to start using your warehouses to import and open up the African market, but they just find the barriers to entry too difficult. The cost of actually delivering goods too difficult. It's still cheaper to deliver to each country individually rather than set up a local production plant in Africa. So again, that's all constrained by the cost of logistics, the cost of infrastructure. As those are overcome, and I think to Alice's point, there is actually huge progress. Having been doing this for 10 years and building warehouses, the situation today is substantially better than it was 10 years ago, but there's still an awful lot to be done. But I think the positive is there is a huge market waiting to explode as and when those issues are resolved.
I would just say, you know, we've got to make it easier for capital to flow. I will stick with your number that it costs 25% more to build a logistics park in Africa than it does in other parts of the world, which is terrible. These are the poorest countries in the world, which should have amongst the cheapest labor. But just think about the difference that investing in infrastructure can make in reducing those bottlenecks. You know, focus on the externalities. And let's keep pushing the frontiers of efficient, you know, financing structures to optimize the capital that is ready to deploy to make, you know, each dollar really count.
And I will probably add that it costs 25 more expensive because of the level of development of the continent. We are still the least developed continent across the globe. So we have to be cautious and patient that, yes, it's more expensive because of the level of development of the regions. However, for me, what makes me hopeful is 5 years ago, or even 10 years ago, investors, sponsors, developers were waiting for a framework to be created before they can come and do their business. But now you have companies like Agility, like micro companies that acknowledge that I have to create the market for myself. So I think that's a fundamental shift that we're seeing in not just in the infrastructure space, but across investment in Africa, that investors are aware that it's as much as their responsibility to make the market ready than the government job as well. And for me, I think as long as we keep that in mind, and we're also very clear in terms of risk-sharing allocation, we'll be able to manage the risk and the challenges going forward. Thank you.
Well, thank you so much, all four of you, for sharing your takeaways. So I guess it's pretty obvious for everyone to see the challenges are there, but here's 4 people on stage who can deal with it, who manage this, and who succeed in these challenges in infrastructure. So I would like to ask you for an applause for our panel. So Alice, Victoria, Geoffrey, and Michael. And I think Sarah has some concluding words for us. You don't have? Okay, then I have the concluding words. Thank you so much for participating. Don't run away if you have questions. The panelists are still here. Thank you so much.